Sailesh Bhan, the CIO Equities at Nippon India Asset Management Company. Sailesh, first up, thanks so much for dropping by and happy Dhanteras and season's greetings to you.
Thank you so much and wish you and your team happy Dhanteras and happy Diwali as well.
Let's hope the coming Samvat is as good as the year gone by was, because it was rather kind when it comes to the equities market. But let's talk about the next year, and that's the first question that I want to ask you that will come up on the screen as to what the best asset class is going to be in the next Samvat, which is 2081. Indian equities is something that we, as it is, have a bias for, but global equities in the sense of US and China do, stand mention. Gold has done very well, that 30% gain that we have seen this year already, and debt because of course, the entire rate cut cycle which has started. With that construct in mind, what would you call the best asset class?
See, Indian equities should be good, right? It's just that the time frame and which segments you want to be in, but Indian equities should be good.
Okay, with segments, and we'll come to that, but at least from Nifty or the frontline index, what should be the return expectation? Because we've been spoiled in the last couple of years. We have seen returns of about 19-20% for 2 consecutive years. Is it going to be another year with a bumper gain or not so much?
I think it will be a single digit return.
Okay, so 0 to 5 or 5 to 10?
5 to 10, I guess.
Okay, we're not that bad yet. It is at least going to be 5 to 10%. Let's just focus and talk about the biggest risk for the market, because this earnings season hasn't started well and everybody is telling us that the risk is more skewed towards downgrades versus upgrades. So that, of course, one of the worries. Geopolitics, we know what's happening across the world and how that has been impacting the overall sentiment, and then valuations. 21-22 times is what India is trading at the higher end of the range. So within all of this, what will you call the biggest risk?
I think valuations themselves are the biggest risk, because earnings, will be cyclical at most points of time, right? But valuations clearly are the thing to worry about.
Okay, let's see. Hopefully, perhaps earnings catches up faster so that valuations come off a bit. Let's see which side that goes. The next one that we have, and this one will be interesting because you, of course, have been looking at all the funds, and it's like picking your baby out of one. But which of these will you go for? Perhaps if you had to put your own money to work, would you go for large caps where there's bigger comfort, mid cap which has outperformed, multi-cap that keeps everything balanced, or perhaps some sort of thematic, the likes of defense, energy that had come up in the last year?
Clearly, there's large cap is the space to be in, where there is relative sensible value there.
So blue chip, going for that one. And lastly, which sector will be the one that you think will outperform this year? Because financials was that consensus trade, IT had gone through its downturn, it's recovered quite a bit, and energy is that bigger theme that everyone is talking about. These or anything else?
Financials appear to be the most sensibly priced, and they could have an opportunity for doing well.
Private or public? Or even insurance or brokerages or whatever?
Private large banks.
Okay, private large banks. Let's try and decode that a bit more then. Private large cap banks is something that you like at this point of time, but what about PSUs as a whole basket? And I ask you that because it got re-rated last year, and there was that disbelief that perhaps, the operational efficiencies can't really kick in. They have proven that to be wrong, and we have seen one leg of the re-rating. Do you expect another leg, or do you think now they are fairly priced?
So, if you look at the PSU construct, right, PSU banks specifically, the leaders are sensibly priced, so there is no challenge there. The challenge is in thematic PSUs, where there has been a huge rally in the last 2 years.
You mean the railways and defense sort of world?
So we are actually paying a lot for growth already in these businesses. And, it takes time for all these things to be executed. If you are upfronting the valuations for these businesses way ahead of time, then you would have a lot of disappointments. I think, like you rightly said, it's actually unreal expectations in the minds of investors, which is the problem. It's not India, it's not the economy, it's just the valuations and the unreal expectations which are there.
So then, as per your understanding, as per your internal estimates, how many years of growth is already priced in, specifically when it comes to the defense and the railway pack?
So a lot of people are looking at FY27 numbers, unable to justify. They're looking at FY28, right. They're unable to justify, they'll roll over to FY29. So I think the problem is it's because the markets haven't, corrected so much. I mean, they've seen some correction recently, but have been doing well. Right. Just people are wanting to justify with FY28, 29 numbers. But, these businesses are not like an Excel line. They have their own cycles, they have their own need for capital, they have their own execution timeframes and all that.
So then, along with valuations, earnings is also one of the concerns when it comes to markets. Now, Q2 earnings are weak. How are you understanding about the H2 numbers to be for this financial year, and even for FY26, are you expecting or are you penciling in at least a 10 to 15% growth?
Yeah, if you look at the construct of earnings today, where are the earnings not coming from, right? The problems are global geopolitical issues not allowing for very good growth recovery. Then domestic rural side was struggling. Now urban has started to give up a bit because of the large base. If you look at the construct last year, the margins of companies shot up dramatically. So we are actually at peak margins and our revenue growth is weak today. I think maybe the second half will be way better than the first, just because of the festive season per se, and also the fact that the base effect becomes a little more normal, because last year the second half was a little muted. And over the next 2 years, that is FY 26-27, earning recovery should be good, and they should go back to the early double-digit numbers.
So given that we are talking about festive season, and given the fact that rural recovery could also pick up on the back of strong monsoon. So one thing that, and we noticed that from last summer to this summer, FMCG is one sector which has given the lowest return compared to other sectoral indices. So do you think the valuations are apt right now to enter consumer stocks, given that H2 demand recovery could be much better?
So consumer valuations have been expensive for a long time, right? And there was also a rally recently to because other sectors were expensive, people went into it. I think this is one sector where earnings expectations are the lowest. Hence the valuations are far more sensible. See, they may appear on a much higher basis, 40 multiple and all that, but I think our earning expectations are very low because of the disappointments of the last 2 years. I think that can shift in the next 1 to 2 years. And hence this space might become more, or might appear much more sensibly valued if you look 2 or 3 years out, because this is more secular than normal. Right.
Shailesh, the other thing that we guys keep talking about is how your small cap fund has managed to outperform and give stellar return. Of course, thanks to the market being kind to us as well. But how do you manage a large portfolio of that size? 60,000 crores if I have it right. And in this kind of market, how are you looking at incrementally investing within the small cap and the broader market category?
Yeah. So we have built a very strong research team. So we cover close to 475 to 500 companies internally, which allows us to have a larger cross section of companies to be invested in the fund. So we diversified the fund appropriately, making sure that the liquidity aspects to a large extent are taken care of. And that allows us, to have, you can shift across markets even if you have a lesser exposure in specific stocks. Second is, last year we have stopped taking in lump sum money.
Yes.
So that allows us to be able to not be, creating an impact of new money impacting the cost of investments and things like that. So that's how we do it. And our focus is to make sure that within the universe, we buy the best available businesses, in the sense, attend more based on research to identify businesses which have longevity. Because cycles will come, there can be corrections, there will be cycles, there will be challenges, because the category is like that. But the idea is, somehow most of these businesses should stay long.
That's true.
That allows. Plus also we have about 30% in non-small caps, which allows us the maneuverability which is needed and lowers the risk of the portfolio.
But if I had to ask you, there are a lot of these overarching themes that we're talking about in India. A, of course, is manufacturing and the way we are likely to become the export hub. A lot of new niche businesses are coming up which are opening up for exports. There's this Gen AI opportunity or disruption, whichever way you call it, quick commerce, and a lot more which have come in, including energy transition. If I had to ask you to pick one theme that you think is something that investors should watch out for as a trend for next 10 years, and perhaps will give you the max amount of multi-baggers, which theme would you call it, or any other?
A lot of the themes which you have talked about a lot of them are getting priced very, very quickly. See, it's a starting point is very, very high. So this is not the time to really look
any
at
undiscovered theme that you can talk to us about?
See, luxury as a theme. I mean, if you cut through and find out companies in that space appears very at early stages in India. So that can be a multi-bagger. But a lot of the themes, there's so much money chasing all the thematics you've talked about, right? So to get them captured and get larger returns out of them is actually difficult, at least for the near term.
That difficult job is something that we hand over to you to do that.
Well, one more theme that has been very quite active with the last summer, this fundraise, be it QIPs,
Yes.
be it IPOs, they both are at multi-year highs.
Yes.
But given the fact that market is now expected to consolidate, but there is also too much liquidity in the market. So how do you expect QIPs and IPOs to move on going forward? Do you still expect more number of fundraise to happen?
So there is a crazy amount of inventory of fundraisers in the system.
Right.
So, we just cannot escape our office without meeting promoters wanting to raise money, right? And hence there is this narrative that, the money keeps coming in, there will be demand for equities and markets will keep going up. I think there is enough and more supply. See, among the largest IPOs in India has been a multinational company selling their India business. It's not been an India company raising it. So I think if pricing is right, if pricing is sensible, there is enough and more capital for any business. Right, so I don't think there is a challenge for good priced, good quality businesses. but we see very few of them generally hitting the markets. A lot of them are very frothy and
So
very
you're not
challenging.
that active in the IPO market, would you say? At least, let's say, if there are 10 IPOs coming in, would you just invest in 2 or 3? Because you're saying some of them are getting into the frothy category.
So that has been our approach for the last now 12 months. And I think we're finding that, because there is so much of money flow and so much of interest, we are finding even fragile businesses, frothier businesses coming in.
I've
we
heard
just
so
want to be
many
careful.
anecdotes about fund managers fighting for anchor allocations and all of that, and the way you're saying
That's
that.
only when the valuations are cheap and the grey market premium is
No,
at least
I mean, even for companies which have higher valuations, there's enough amount of fight for the anchor book. And of course, as you said, there's those slew of promoters who are lined up every day who are trying to do the fundraise. But before we continue the conversation, why don't you take him across and try and get some insights
Wheels
from the
of
Wheel of Fortune?
So this is the Wheel of Fortune. Wherever it lies, you have to answer the question. And the first one will be the sector to watch out for, other than financials.
So there are very young sectors in India, I mean, which are I talked about luxury as a theme, right? I mean, so likewise, if you look at select thematics, but with a medium-term view, there are good opportunities there for luxury across segments.
Across segments, be it car,
Yeah.
be it watches, like there is a
Yeah,
company
yeah.
called Ethos. So across across the board, luxury is a theme.
Yeah.
Well, the next one would be your multi-bagger idea. Could be a sector other than luxury or financials, if anything. Or else we can
I think
choose
see,
something else.
the starting point is generally high
Okay.
today in the market. So I think, and investor expectations are also generally unreal. I think this all leads to larger risk today. I think all multi-baggers are made only in a bear market, boss. I think multi-baggers have peaked in India at least for some period of time.
I think that gives us a good headline that
Right.
multi-baggers, at least for the very near term, have peaked in India. And we have seen quite a few in the last couple of years. Let's
The
take
last
one
one.
final one.
Well,
Your biggest
Biggest
regret.
regret.
Let's go with that.
So in India, we've always found that India always under delivers in the short term, but disproportionately delivers in the long term. I mean, I think this whole idea is to get that thing right at most points of time. And in the last 30 years of investing, there are so many such cycles we would have missed out on some large number of brilliant businesses.
Any
So I think-
recent one that you want to call out?
I wouldn't
I'm sure
take
there
stock
would be a
names,
list,
but
but fair enough.
there are many sectors and themes where we could have been way better than what we would have been.
Yeah, because there's that disbelief in some of them that is always there, whether it was PSUs or railways or defense, at least for some of us. That
PSUs also actually for a very long period of time did not give any return, and it was in the last 2 or 3 years when they
See,
Suddenly
their,
shot
their
up.
valuations are sensible, we don't have a problem. So when valuations are good,
Just stay invested
those
as long as
spaces
the
have been
valuations are
extremely attractive and worked. What happens is when businesses get extremely highly valued and still deliver disproportionate earning growth, which surprises us, is where there is a challenge. Otherwise, defense and public sector and all cyclicals, cap goods, all of them have been very helpful in the last 3-4 years for us.
Oh, well, yes, in fact, the rest of the market too has been very helpful. With that, we'll thank Sailesh for dropping by.